Hello everyone, welcome to today's video and this is your friend Aceink. In March 2020, the whole nation was shocked because Yes Bank was about to collapse and none of the account holders were able to withdraw their money from the bank. And till now, everybody thought that banks were the safest place to keep our money, but now that trust was shaken to its core. And from that devastating point, Yes Bank has come a long way, where it has seen it all, from an unbelievable meteoric rise to a shocking banking fraud. Not only just the Yes Bank account holders, but also the Yes Bank shareholders were also devastated because Yes Bank was once a shining blue chip stock which was trading around 400 rupees per share before crashing to become a penny stock, and at one point of a time the stock price has even fallen to 6 rupees per share. So in today's video we will try to understand the rise and fall of Yes Bank and how Yes Bank managed to come back to life from the brink of bankruptcy. And we'll also try to understand why the stock price of Yes Bank is not recovering and will it ever recover to its peak price of rupees 400. But before we go forward, me and my team, we really work very hard to make such kind of a quality video for you guys. And if you want to appreciate the efforts we put in to make such quality content, then you can press the like button and like the video, and also press the red button to subscribe to the channel. So let's begin from the start. So it all started in the year 1988 when Rabobank came to India. And that's when Rana Kapoor, Ashok Kapoor and Harshit Singh bought 25% stake in this bank, and later they sold their stake for $10 million in the year 2003 and exited Rabobank business entirely. From there, Harshit Singh moved on in his life, but Rana Kapoor and Ashok Kapoor had a vision of building the best quality bank in India. And in the year 2004, Reserve Bank of India granted banking license and they established Yes Bank. So in this whole equation of Yes Bank, Ashok Kapoor was the mastermind because he was a very well-connected person in the banking industry, and it was only because of him Yes Bank got the banking license from the RBI. And on the other hand, Rana Kapoor was an aggressive business tactician and he publicly and famously believed you need to invest big to grow big. So both Rana Kapoor and Ashok Kapoor had different ideologies, but together they were perfect business partners. And at this point of a time, things were really going well for Yes Bank. But then the horrifying 26/11 Mumbai terrorist attack, which shook the entire nation, also shook Yes Bank personally because Ashok Kapoor was killed in that terrorist attack. So now from the equation of Yes Bank, the mastermind was gone and what remained was an aggressive business tactician, which was Rana Kapoor. And Rana Kapoor took a very aggressive approach to grow Yes Bank under his leadership. And initially Rana Kapoor's aggressive approach was working really well, where Rana Kapoor was able to give very risky loans at a very higher interest rate and also recover those loans to the last penny. And because of this super ability, Rana Kapoor was even famously labeled the lender of last resort, because during that time when all other banks were struggling to recover their money, Rana Kapoor had even recovered loans given to the infamous Vijay Mallya. And also to increase the deposits in Yes Bank, Rana Kapoor offered 7% interest on Yes Bank deposits, which was way higher compared to all other banks during that point of a time. And customers rushed to Yes Bank to open their accounts, because of which their deposits grew from 74,192 crores in the year 2014 to a hopping 2,27,610 crores in the year 2018. So at one end, Yes Bank was reaching new heights of success every single day, but on the other end, there were few companies which were failing miserably day by day. And few of those companies were Reliance Anil Dhirubhai Ambani Group, SL Group, DHFL, Jet Airways and Omkar Retailers. And these companies which were failing miserably had taken very big amount of loans from Yes Bank. So this was the exact point from where Yes Bank was about to fall. But wait a minute, didn't we discuss few minutes back that Rana Kapoor was labeled lender of last resort who had even recovered loans from Vijay Mallya? If so, then how Yes Bank came to this point where they ended up giving loans to such miserably failing companies and was not even able to recover those loans? So honestly speaking, it's a puzzle, and this puzzle has two parts. So the first part of the puzzle is turning Yes Bank into a corporate lender. So now many of you might be wondering what or who is a corporate lender and how it contributed to the downfall of Yes Bank. So let me explain. So in the banking industry, we can make two broader classification. Classification number one is retail banking, or you may call it retail lender, and classification number two is corporate banking or corporate lender. So first, let's try to understand who is a retail bank or a retail lender. So these are the banks who give majority of their loans to retail customers. And who is a retail customer? I am a retail customer, you are a retail customer, and all the office going people are retail customers, and all the people who own small businesses are also retail customers who basically take smaller loans to buy car, house or to invest in their business. So in retail banking, smaller loans are given to large number of customers. So just to understand it much better, let me give you an example. So let's say if a bank has 1000 rupees in deposits which came from their customers through savings account, current account and fixed deposits. And for this the bank is paying around 5% of interest to their customers. And now the bank will take this 1000 rupees deposit and give loan of 10 rupees to 100 different customers. And on all these loans they will charge around 12% interest rate. And generally in banking business, few customers who have taken loans will default and banks will have to face losses because of these loans that went bad. So in our example, if we assume 5 loan defaults, then the bank will have to face a losses of around 50 rupees. And the remaining 95 good loans will earn 12% interest, which is equal to around 114 rupees. And also the bank will have to pay 5% interest on the 1000 rupees deposit which its customers have kept in the bank in the form of fixed deposit, current accounts and savings account. So now if we equate the earnings and expenses, then bank has earned 114 rupees in the form of interest and it has paid a 50 rupees loss from defaults, and the bank has to pay interest of around 50 rupees to its depositors. So after equating this, the bank is still making 14 rupees of profit even after 5 loan defaults or 5 loans went bad. And for this reason, retail banking is considered to be the safest option of distributing loans in the banking industry because it carries very less amount of risk. So now if you compare it to corporate banking or corporate lender, a corporate bank would give majority of its loans to corporations or corporates or companies, which could be Reliance Industries, Adani Group, Tata Group, and in some cases it could also be Kingfisher, Vijay Mallya or Nirav Modi. And in corporate banking, bigger amount of loans are given to a very small number of customers. So to give you an example, if a bank has 1000 rupees of deposit on which the bank is paying around 5% of interest to its depositors, and now the bank will distribute this 1000 rupees of deposits and give loan to only 10 customers of 100 rupees each. And because it is a corporate loan, they will also charge a higher interest rate of around 15%. And now even if 2 customers default, then the bank will face a loss of around 200 rupees, which is a massive loss. And if you equate the earnings from interest, the interest it pays to the depositors and the 200 rupees default, then the bank will have to face a loss of hopping 130 rupees. And this 130 rupees the bank has just lost is the depositors' money. And now the bank has to return this depositors' money either from their accumulated profits, and if the company don't have accumulated profits, then it has to raise funds to repay this loss of 130 rupees which actually belongs to the depositors who have put money in the bank in the form of fixed deposits, current accounts and savings accounts. So in corporate banking, even though banks have a higher potential of earning more money in the form of interest, but still it carries a huge amount of risk which can potentially destroy a bank if it is not managed properly. And this is the first part of the puzzle where Rana Kapoor turned Yes Bank into a corporate lender or a corporate bank which gave 65% of the loans to corporates. And this is how Yes Bank ended up giving loans to Reliance, Anil Dhirubhai Ambani Group, SL Group, DHFL Group, Jet Airways, Omkar Retailers and many more. And some might say here, come on, how can it be possible? Because there are other banks as well who give corporate loans, but nobody ended up giving loans to so many bad companies. But how come only Yes Bank ended up giving loans to so many bad companies? And if you think so, then you are exactly correct. And that's where comes the second part of the puzzle. And this is where Rana Kapoor willingly gave loans or sanctioned loans to those companies which were really doing bad or they were about to go bankrupt. And here you might ask a logical question. Why Rana Kapoor will do this to his own bank? So Rana Kapoor secretly partnered with these bad companies for his own personal benefit, where he was taking bribes and commissions for sanctioning loans to such bad companies. And this fraud of Rana Kapoor exponentially increased the loan recovery risk for Yes Bank, which ultimately led to the fall of Yes Bank. Because of which in March 2020, Yes Bank had even reached the brink of bankruptcy, which kind of triggered an alarm at a national level. And if Yes Bank was allowed to fail and go bankrupt, then the citizens of the country would not only lose trust in Yes Bank, but also in other private banks like HDFC, ICICI, Axis Bank and many more. And that's why RBI and Finance Minister Nirmala Sitharaman had to step in, where they bought in State Bank of India to form a restructuring plan for Yes Bank. And it was also in the interest of other private banks to save Yes Bank in order to avoid loss of trust on private banking sector. ICICI Bank, HDFC Bank, Axis Bank, Kotak Mahindra Bank and many other banks also stepped in, and together they invested around 12,000 crore rupees in Yes Bank in exchange for Yes Bank stocks. And State Bank of India was the biggest investor who took around 49% stake in Yes Bank. And as a part of this restructuring, State Bank of India even appointed one of their seasoned bankers, Prashant Kumar, as the new CEO of Yes Bank. And during that time, everybody underestimated the capabilities of Prashant Kumar, but later it was him who successfully turned around Yes Bank and became the game changer. So when Prashant Kumar became CEO, even though the investments from SBI and other private banks had saved Yes Bank from immediate bankruptcy, but still Yes Bank was in dire needs of funds to survive. But nobody was ready to give those funds because Yes Bank had too much of non-performing assets on their books. And what is a non-performing asset? All the loans that were given to the bad companies which Yes Bank was not able to recover became non-performing asset or NPAs. And that's where Prashant Kumar showed his brilliance and came up with a plan to move all the NPAs to an asset reconstruction company. And after many years of struggle and so many challenges, Prashant Kumar finally managed to sell all the NPAs of Yes Bank to an asset reconstruction company called JC Flowers. And now many of you might be wondering, what is an asset reconstruction company or an ARC? So an ARC is an reconstruction company which buy bad loans from the banks for a one-time payment to the bank. And then the asset reconstruction company will try to recover those loans, and if they succeed, they will make a good profit on that. So after selling the non-performing assets to an asset reconstruction company, the way was clear for Yes Bank to raise funds. And within a few months of time, Yes Bank managed to raise 8,900 crore worth of funds. And now everybody knew that Yes Bank again became capable of raising funds, which slowly and steadily reinstated the trust of investors in Yes Bank again. And also after so many loss-making quarters, Yes Bank also became profitable in June quarter of financial year 2021, and it continued to be profitable in every quarter till date. And also the fundamentals of Yes Bank are steadily improving, where in financial year 2022 it has seen an 18% rise in deposits and 14% rise in loan advances. And Prashant Kumar also turned Yes Bank from a corporate bank to a retail bank, where now they are focusing more on giving loans to retail customers which are smaller in size, like car loans, home loans and personal loans. Because as we had discussed earlier, default risk in retail loans is very low compared to corporate loans. And Yes Bank is also aiming to double its retail loan book in the next 3 years. But now, even after listening to all the good things about Yes Bank, like how it came back from the bankruptcy, how it is fundamentally improving, or how it became profitable, the investors of Yes Bank might be thinking or even wondering, if so many good things are happening in Yes Bank and if Yes Bank is recovering, then why the stock price of Yes Bank is not recovering? Because previously this stock was trading at around 400 rupees per share, but now the stock is even struggling to cross 20 rupees. So to understand this, why stock was 400 rupees before and now not even 20 rupees, we have to understand what happened during the restructuring of Yes Bank. In order to understand this, let me give you an example which will also help you understand how stock market works and how a stock of a company is priced in the stock market. So let's say there is a company called Nice Biscuits which basically manufactures various kind of biscuits. And now this whole company is divided into 10 shares, which means if you own 1 share, then you own 10% of the company, and if you own 5 shares, then you own 50% of the company. And this company is earning a net profit of around 100 rupees per year. So now what should be the price of each stock? So the stock price is decided by 2 factors. The first factor is earnings per share, which is nothing but total earnings or net profit divided by total number of shares. So here the net profit is 100 and we are dividing it by total number of shares, which is 10. So after equating this, we'll get 10 rupees earnings per share, which is basically nothing but how much profit each share gets. So now the company in total is earning 100 rupees net profit, and out of this 100 rupees net profit, each share of the company gets 10 rupees earnings per share. And now for this share which is earning 10 rupees, an investor is ready to buy this stock at 50 rupees, then its price to earnings ratio becomes 5. And if an investor is ready to pay 100 rupees to buy this share, then its price to earnings ratio becomes 10. Which means if an investor is ready to pay 100 rupees for a share whose earnings per share is 10 rupees, then that investor is ready to pay 10 times more money than its earnings per share to buy the share. So in our case, let's assume the price to earnings ratio is 10, which basically brings the stock price to 100 rupees. And now let's say after a few months the company goes into loss and the company has to raise funds of around 1000 rupees to survive or avoid bankruptcy. And And now to raise funds, the company goes to an investor and the investor agrees to give them 1000 rupees funds in exchange for 90% of the company. And the company has no other way because it has to survive, so it agrees. So now in order to give this new investor 90% of the company does a share dilution on the existing investors. So what is the share dilution? So before, the whole company was divided into 10 shares, but now they will divide the whole company into 100 shares. So think of it like a pizza. You can cut the pizza into 4 pieces, 8 pieces, 10 pieces, or even 100 pieces. Which means the more number of pieces you make, the size of each piece will become smaller. And the same way, a company divided into 10 shares means if you owned 1 share, then you held 10% of the company. But now when the whole company is divided into 100 shares, now if you own 1 share, then you own only 1% of the company. So now after dividing the whole company into 100 shares, they will give 90 shares to this new investor, which will effectively make his shareholding 90% in the company. So now let's see what happens to earnings per share after the company is divided into 100 shares. So now earnings per share is equals to how much? The company is earning net profit of rupees 100 and now the total number of shares are 100. So if you divide 100 by 100, then you get 1 rupees earnings per share. So before, the earnings per share was 10 and now the earnings per share is 1. And if you consider the same price to earnings ratio of 10 or the valuation of 10 like before, now what will be the stock price? 1 rupees earnings per share into 10 price to earnings ratio, which is equals to 10 rupees per share. So before also company earned 100 rupees net profit, now also company is earning 100 rupees net profit, but the only difference is before the company was divided into 10 shares, now the company is divided into 100 shares, because of which the earnings per share, which means how much net profit each share is getting, has also become smaller, which was 10 rupees before and now it is only 1 rupees. And that's why before the share price was 100 rupees and now the share price is only 10 rupees. And this is what has exactly happened with Yes Bank. Because before RBI restructured Yes Bank, the total number of shares were around 255 crores. But after the restructuring, where SBI, ICICI Bank, HDFC Bank, Axis Bank, Kotak Mahindra Bank and many other banks invested money and bought stake in Yes Bank, the total number of shares increased from 255 crores to 2505 crores, which has effectively diluted the existing shareholders and also diluted the earnings per share. And this is the reason why the stock price of Yes Bank was trading at 100 rupees, 200 rupees, 300 rupees and even 400 rupees at one point, but now it is even struggling to cross 20 rupees per share. So now according to the stock price formula, if the stock price has to increase, then the valuation of the company or the price to earnings ratio of the company has to increase, which depends on how well the fundamentals of Yes Bank recover and how strong Yes Bank becomes in the near future. But remember, price to earnings ratio has a limitation. After a certain point of a time, it can't increase further. So in the long run, if the stock price of Yes Bank has to increase consistently, then the bank needs to increase the profits it is earning in order to increase their earnings per share. And in the long run, only profit growth can push the share price forward. So presently, if you see, Yes Bank is earning around 1170 crore rupees of profits per year. And if the stock price has to reach 50, 100 or 200 or even 400, then the bank has to earn multiple times more than the net profit it is earning right now. But ultimately, only time will tell how much profits Yes Bank can earn in the coming future. But you can tell in the comment section what do you think about Yes Bank and what can be the share price in the next 5 years or 10 years time period. So that's it for today guys, and if you like the video, then please make sure to press the like button, which will make YouTube algorithm happy and help this video to reach as many people as possible, and press the red button to subscribe to the channel and also hit the bell notification to get an immediate update as soon as we upload a new video. So thank you so much for watching. I will see you in the next video. Until then, this is your friend Bharat Shankar signing off.